One of these Mondays, we're going to come in here with good news, but it's not this Monday.
Welcome to Hedge Heads, where hosts John Prishman and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, I am just rolling back into town after approximately 10 days of camping in pretty much every possible weather condition. 3 inches of rain over 2 days on one part of the trip, and then it was about 90 and as little wind and as much humidity as you could get my last 2 days of camping. So I'm glad to come back and see these markets.
You're refreshed. You say you're on vacation. I say you were hiding from the grains, and that everybody's hiding from the grains.
It appears the grain bulls went with me on vacation.
Yeah,
that's ugly.
Very, very typical Monday. We had more rain over the weekend, and so you had the big cattle on feed report. So over this episode, let's go over the general commodity overview, what's to be expected. We'll definitely hit cattle. Energies, interest rates. The problem we've been having with commodities is these trade deals and how is it going to affect what market when. And it's really been kind of winding down. Like, even though the tariffs went back on, the markets haven't had much of a reaction. Now most of the trade deals are done. China's got an extended deadline to renegotiate. That could be big news for grains later. But still, it's been this wait and see sort of market, and while we're waiting, everything falls except for cattle.
Right.
And so it's been one of these deals where you kind of just are waiting for something to change. Maybe it's going to be a trade deal. You can't commit, but everything's sliding at the same time and it's just getting worse. Then it keeps raining. You go on Twitter, you're going to see too tight tassel. You're going to see not pollinating right. You're going to see all kinds of stuff that you want to see this time of year if you think it's mispriced. Normally the argument this time of year is it's not that yield. Now you're really not hearing that this year. Let's say they had trend line at 178. You'd be hearing it's 174, 172, 170 at best. We don't even have those arguments this year. It's just, I think the market's trading 185. I think it's trading 187. They're arguing over what they think the market's trading. I personally think it's trading 181. I think that they made their bet in February that the numbers from the USDA weren't right. And they said, hey, the cash market stinks, basis stinks. We're going to start selling this thing. And they haven't let up. Then the spring let them off the hook with the good weather. Then the summer let them off the hook with the good weather. There's just the possibility these guys are just on the right side, realizing there seem to be a lot more corn around than not. But the arguments are, what number are they trading right now? And who really cares? Does it matter? What's your number? Let's play this game.
No, I'm not playing it. I refuse to talk grain to start this podcast. Let's talk anything else.
Well,
let's talk cattle. Cattle on feed report. The cattle is the market. I'm shocked at how much higher it is since I left.
Yeah.
What's going on here?
So it's been lagging the cash. So you look at June, it was the last contract that went off the board. It went off the board at 225 with cash at 243 in the north to 240, and then 230 something in the south. Yet it never got to 230 when it went off the board. August now has changed gears. It's saying, hey, we've been underpriced for too long. Let's get closer to cash. Cash is no higher than it was, a month and a half ago or a month ago. So the futures are the difference there. The basis is disappearing. It can do that. Market can have wide basis. It can have positive basis. It can do whatever it wants. The futures, rising open interest means new participants, so they're jumping on the wave of cattle. Now, we could stop it, of course, by buying a few cattle contracts, and if we do, we'll let you know. We'll stop it dead in its tracks. But cattle's been the bright spot. This has been very happy news for the cattle guys. The cattle barns are on fire. You talk to these guys in the barn. I think I'll probably go to the sale tomorrow here in Fergus and see what's going on. But they all shake their heads. They can't believe it's up where it is. So you have this market that is what it is till one day it won't be. And I know that's a little vague, but meaning we're most likely going to find some sort of major cash top at some point in this window, whether it's $10 higher or even more, or today is the day. We had the cattle on feed on Friday with the quarterly, and it was all good news, but it did show some herd. For the first time, they held back heifers, and they're going to start expanding the herd, or at least it looks like that. So when does that hit? 2027? Short 2027, I guess. But those contracts aren't even up yet. But it will be for the hedgers out there. Now, here's the important thing. There'll come a turning point here where if you hedge correctly, and there's a lot of different ways to do it, that you'll be the guy getting 225, 224, 220 a year from now, and everybody else is getting 180. Now, that might not happen even in a year, but there'll come a time, as there does every market. And this seems like a market that's going to be pretty soon, because all the hedgers that have hedged this thing are obviously beat up, meaning they've been making margin calls for a very long time. And when it comes to the next round, they're not going to be any mood to do it again. And they're going to skip it, and that's how those high prices of the second round kind of disappear. Others will argue this thing's here forever to stay. This is a fundamentally different market. People's tastes have changed, and we're going the protein way, and it's going to be beef, 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 and we're not going to rebuild the herd. I mean, I think the answer is somewhere in between what the extreme, like going back to where we just were and, never changing again.
Usually it's in the middle. I mean, educate me here, though, on cattle. So you said June went off way under cash.
Yeah.
They're supposed to meet, right? Like how? So are there deliveries as a cash set? What goes on when it goes that far under cash?
You can deliver, and you can't demand delivery. I wish you could, and then that would converge a lot better. But it was at that point close enough to cash, and that it was able to go off the board that way. It was 221, 222, and then it surged up to 225 in the last couple of days. The feeder cattle will go to cash. That is an index, so that's basically an average price, and then they do different sale barns. They do different every day. It's a number of different sale barns, so they try to get this average price. That one, in the end, no matter what, will meet where the index is at the end, even if it's in the calculations a couple days where the futures aren't even active. So you can be long a feeder cattle contract or short, buy or sell, and you don't have to get out. And lean hogs are the same way. It's an index where the cattle contract is a physically delivered contract. So there would be guys interested in buying that contract and getting it delivered for that price for sure. But at the end, it gets thin, and it didn't want to get to even 230. So we're at daily highs. I think these are new it's hard to keep track of. But at one point, it will be done, whether it falls a lot or not very much or settles into a range up here. It's hard to know. But we are getting long in the tooth. Demand's eventually probably going to be the undoing, and we are at a seasonal time where you could see a peak. But it's also a roaring bull market with new highs, and that's never really bearish. And if you're in there, I would suggest options, or if you're intraday, using some sort of reasonable stop, because it is a market that's pretty unforgiving. If you're on the wrong side, if you're on the right side, those guys are laughing. But
right.
You don't see much of that on Twitter. There's a few guys that claim that they're on the right side or they're unhedged and stuff like that. But overall, Twitter cattle stuff is pretty quiet. I think the guys that are out there working hard, raising the cattle, are enjoying this, and they deserve it.
They definitely deserve it. Talk to me about energies, because I see crude oil had a great day today, but it's kind of also right where it was when I left. So
a great day for crude oil is a bad day. A great day for crude oil long traders. Bad day for everybody else that buys energy.
Yep.
So it's been this yearly quiet market. There's been a lot of Middle East stuff going on, like a lot of stuff that could have made it go higher. So it's caught between OPEC pumping a bunch and the tensions, and so it's just settled into this very quiet range. Crude oil is 67.08 right now, and it's been in between 61, 62, and 67, 68, and it's been there since July. You had the big Middle East tension, and then come down. So what's the outlook? What do I do if I need to fill the tanks up for the farm? What are we looking at? It doesn't look like tightness is creeping in any of the energies. It's not an oversupplied market, but the fundamentals aren't one where this thing's going to explode on just low supplies either. So it's got a balance, and we talked about this in other episodes. Markets look for an equilibrium price. That's what, it tries to get to that, and then the volatility goes down. And it feels like that's what's happening sort of in the grains. That's what's happening in the energies. We found this range at where it belongs at. It doesn't belong in the 70s, and it doesn't. And when it did briefly go down in the 50s, it didn't want to stay down there either. But where do we break out from here? That's the $1 million question. I mean, lots can change in energies very quickly. Like I say, fundamentally, there's no reason to think it's going to march up. We are going to go to cooler weather eventually here. I think, as a matter of fact, August is they're calling it fall-like weather.
Oh,
so
really?
That could be a change for the energies if you get extra cool, extra early. That's going to be more demand than you would normally see. Just as heat also, the AC is running, and that's a lot of energy burn. But we really haven't seen that. It's been this nice little kind of quiet deal. Natural gas has come down from higher prices and has slowly been going down, and there's just been no excitement in the energies. And the speculators haven't driven it up, or the funds. Just kind of just abnormally quiet, I would say. The guys in the business probably enjoy this because it's easier to wholesale this stuff when it's not moving around 1 million miles per hour. What are you seeing at the pumps? I don't see anything way out of line with what it should be or what it usually is. I see no surprises there.
I spent around $1,000 on gas over the last 3 weeks. So, in Minnesota, anywhere from $2.79 to $2.99, never once filled up over $3. At the pump, staying very reasonable.
Yeah.
I would love to see $1.99. Let's go. But, it's reasonable to travel right now by car.
Yeah, considering what happened in the Middle East earlier, to be where we are is kind of shows you the fundamentals. I mean, it's just not an undersupplied market. There's plenty around. I just pulled up the unleaded gas chart. There's nothing there. I can't wait till they get the micros size contracts in unleaded and heating oil. I'm surprised it's taken this long. It'll be really nice when people can hedge 100 gallons, 500 gallons. Well, the big contract, 40,000, is probably going to be a 400 gallon contract. But I think I burned that no problem. In summer, many people do.
Oh man, I burned that. I think on at Lake Week pulling tubes.
So yeah, exactly.
I was burning about 15 gallons a day.
Yep.
Of non-oxy, so we were paying a little bit more at the pump.
I look forward to when this is a hedgeable thing for households. I think it'd be a hit of a product. I think everybody in every town could, utilize it or at least look at it. And let's just say, here's an example. Like a lot of bad news happens during the winter, and they drive unleaded to a really low level. You look at the June contract, and that's a level you would love to pay all summer. You're going to be able to buy these contracts. Right now, they're too big. They're 40,000 gallons.
Yeah, I don't burn that much.
You can hedge, but farms do, they'll
sure.
on the diesel. But if you get these smaller size contracts, what they do have is half size contracts that nobody's in. But it's on the NYMEX exchange. It might be, in the works, might take forever. If it was CME, it would already be out there. But it'll be nice to have a hedgeable, just a nice hedgeable size contract. I think it's going to be wildly popular, and I'd love to teach you guys about it. It's just not there yet. But for right now, no reason to think you need to fill up the tanks. It went up $1.67, so if your tank's low, fill it up today. But we try to make something interesting in the energies to talk about, and there's not a lot. It's actually at a price that it seems to be happy at.
That talking about the micro contracts and things people might be into, let's shift into your currencies and interest rates and that side of things. There is a micro Bitcoin, right? Is that an option? I have people ask about it. Bitcoin futures, that side of things. People are into it. Maybe they don't want to go through the rigmarole of setting up a wallet and the Bitcoin and all that.
There's Bitcoin and all that stuff and all the interest rate products, which we don't talk enough about. You'd be surprised how much that they offer. I think they're going to do they're eventually going to get all the coins. I mean, I'm sure they're going to be. There's talk of continuous contracts where they don't expire. There's all kinds of talk. So it's a very young industry, but yes, micro Bitcoin is here. The large Bitcoin contract, which is actually 5 Bitcoin, so that's a big contract.
That's
so there's
massive.
Yep. So there's 2 different sizes. The micro is obviously a very manageable, smaller size contract. Natural gas has got mini size contract. So I really like the way commodities are trading with the different size, smaller contracts. The part we're missing is the reason they get either long or short any of them.
Right.
It's great that we have all these products, but what direction are interest rates going to go?
Yeah.
Nobody has. I mean, you hear everything you hear in the news every night or during the day. And Powell's going to get fired. He's not fired. They might not even. They might love each other for all anybody knows. There might not be any major changes coming. If he were to get fired, obviously the market would think, here come lower interest rates, and then you'd probably get a big inflationary push. The grain guys, I know you want to talk about the grains, but
we're going to get there. Let's get through interest rates first, though. That's where I want to go.
Their whole thing is if interest rates are going to be this high and it costs this much for all this stuff, like we're going to have to come up in grains.
Yeah.
You haven't seen this inflationary buying in commodities yet at all. We saw a little bit maybe when, a number of years ago, a couple of years ago when everything was starting to come up. But this 2008 when oil went to $150 and they were buying corn to $8 for no reason, that's a big inflationary push, and of course it popped with it just spectacularly and everything fell apart.
Eventually oil went negative.
That's if you're
and
looking,
corn's looking to head that way right now. Let's get into grains. I'm just kidding.
So if it is going to happen, watch energies. That's where it began last time. If they go up, I just don't think gold's going to lead corn up or wheat. Don't rule that out, but I just don't think it's going to happen. Watch the energies. If you see the energies start surging up, then you might get this broad inflationary buying. But yeah, what's to say about the grains? I mean, it is another Monday. I mean, like I say, one of these Mondays we're going to roll in here, and it's going to be a happy up day Monday. No, when you look at what happened, it fell in February and hasn't recovered really. And part of it's bad luck. Part of it is seasonal to some degree, although I'd say we're 2 months early in the winter for a high. What I think happened is the funds realized there's a lot more grain out there than what the USDA's number showed. And in February, they said, we're going to be shorting this market, not as a whole, but that's when the big guys started. And then it started falling. And everybody thought it was tariffs or this, but we were in the spreads. We were, unfortunately on the wrong side,
right?
Because the numbers looked great and it looked like it was going to tighten up, but it never did. And to this day, there was deliveries till the tail end of the July contract. So, back to, are they trading a higher yield or are they just trading what they started in February? I think they're just trading what they started in February. I don't think they're trading 170 or whatever they throw out there, 187 I saw today. Yeah. And all that stuff. It'd be nice to believe that and be confident, well, all the bad news is in, this should just bottom at any time. But I actually think if they were to print 182 in the next report, that it would have a very negative reaction. It wouldn't be a positive. I mean, what do you think?
We kind of started the pod with this, and that gave me a chance to think about it. So I think they're trading 193. That's my hope. And let's print 182 and see what happens to the number. No. Yeah, I do think that it's that one. I mean, I don't even want to speculate on that side because I haven't been paying attention for the last 3 weeks. But we've talked about this. I just don't see a catalyst. There is not a catalyst to change this without beans, maybe if the forecast went hot. But like you said, we're looking at a fall August, even like a cooler August. This is backdoor or backyard itis, but 80 degrees in Minnesota for the first 10 days of August is what they're saying. 75 to 80 for the first 10 days of August.
Yeah,
that's not going to hurt beans.
No.
And
you're not hearing it from any state. Normally you're going to have a rough patch there, and there's going to be guys that are in bad spots, as there is every year no matter what. But as a whole, everybody's pretty happy, and What I find is that you'll hear it might look like this from the road, but once you get in there, and it's specifically for this time of year.
Yep.
Like, because it does look good, the plant looks good, and then you get out there and you are seeing a lot of that online, where they pull the ears back and there's nothing there and it didn't pollinate right. You're going to have that in any given year, whether it's really widespread or not. I don't even think matters, to be honest with you, not till January. Like, when would these numbers start coming out? Well, I suppose if enough people put them out on Twitter in every field they were harvesting and it was over and over and again, they might trade it sooner rather than later.
Look at reality, though. Like you mentioned, what the funds appear to be right. The funds weren't trading the USDA's numbers. There's a reason they were on that side. Well, what do they have that we don't? Is a whole lot of people out there doing research.
Yeah.
Right? And so, yes, maybe if there actually is a huge corn problem, I guarantee the funds have people out there that are talking to way more people than we are. And they're sharing way more info than we have. So, would they see that earlier than the USDA would change a number, which for them is January at the earliest?
You could see it maybe in October or November.
Unless it's super widespread, you're not going to, though.
But for the bottom last year, whichever one's trying to sell, that this is the bottom because this is what happened last year, not necessarily going to do the same thing at all.
Right.
But the spreads turned last year. They were heavily bear spread, and then it quickly turned into bull spreading everything.
Yeah.
And so the spreads told you when the funds were getting in, but what was interesting last year is the spreads told you well before the funds got short that there was something wrong. And you can go back and listen to our podcast. We talked about it repeatedly that the market wasn't acting right before the top come in. I mean, like I say, that's what I like about the podcast library. You can go back and check that.
Yeah.
We talked about it for at least a month and a half before it fell. Now, of course, we weren't bright enough to know that it was going to fall completely, but there was absolutely warning signs there that it was going to fall apart.
Yeah.
So my thing is, for the guys looking for the bottom here, look for some signs like you saw last year, and that would be heavy bull spreading. Base is getting weirdly better, and when it shouldn't be, and absolutely none of that's happening.
Right.
They're widening the spreads out every day still. The basis obviously gets worse this time of year, but the offers, I should say, one guy was trying to lock in 45 and they were at 49, or I don't know. And this is an hour away from here, but you couldn't even get 45 already, and that's not improving. And every week that passes, I really doubt it. Just looking at this crop, you can already tell there's going to be issues with where to put it all, regionally at least. And I think that's going to happen a lot of different places. So you're going to want to find something that would tell you, hey, we're turning around here. Not this just random feeling, this is what the funds did last year, the 5-year seasonal. And I put on my Twitter, 5-year seasonal is great. You might want to include the 10-year and the 15-year because it doesn't tell the same story.
Yeah.
There's been a few bull years in the 5-year. And then when you break it down further and look at each individual year, which I also put on my Twitter, it shows that there's a wide variety of things that could happen in between now and October.
Yeah.
There was a lot of ups and downs to make that average that way. There was no clear direction. Last year bottomed nicely and came up. 2020 bottomed nicely and came up, mid-August.
Yeah.
Those were the two exceptions, and the rest of it was all over the place for the other 3 years. So it all looks great, and you can kind of sugarcoat it and get angry because you can't understand why it's going down. It's going down because people continue to sell it and the cash market continues to weaken. And if that wasn't the case, it wouldn't be going down indefinitely. Now, the one thing that I think is going to be interesting is the soybeans. I know you haven't been paying attention just because you're on vacation. That's great. The soybean margins, a lot of people are talking about, and they are as positive as has been in a very long time, maybe ever. Meaning, they're going to make a lot of money crushing these beans. There's going to be a very good domestic bid at these prices. While this crush margin is there, domestically, we're going to be looking awesome. They're going to make a pile of money. Of course, they're not going to share it, nor do they share their losses with the producers also when the crush margins are negative.
Right.
But still, that'll put a bid under the soybeans. Very questionable on what we're going to have for exports. No idea there. But But at least there's a bright spot. I meant that's something to talk about. I don't think it's such a bright spot for meal. It's already in the dumps, and they're going to crush for the oil and the margins now. It's like, meal looks like it's got some headwinds here, but you never know. But at least there's a little glimmer of hope there. What I don't like is, and we say this often, just wait a week or two, and there's many changes. This has just not been that summer. It's the same every single week. Up maybe Thursday, Friday. They didn't even do that this week, and then kill it Monday with more than expected rains. And it hasn't changed, and there hasn't been a catalyst, like you said. There's been nothing, absolutely nothing in the energies, nothing besides the cattle being very strong. That's been the only notable thing. Otherwise, all these markets are really forgettable. And truthfully, these are traders' markets. These are not hedging markets in the grains. You're buying or selling corn with a 5-cent stop. You're buying or selling beans with a 10, 15-cent stop on whatever methodology you're using. And you're hitting singles and doubles, and you're trading more than you're hedging here. The options just really aren't, look at the implied volatility. Now,
I am looking at this. So you talk traders market. I'm just going to throw one that I'm watching real close.
Yes.
The $11 November call on beans is 6.5 cents. That's, you got 88 days, John.
Yeah, and you got 30 days of good weather, it looks like, coming up.
I know, but that's why I'm watching and not recommending you should buy it. I'm watching it. You're
not wrong on the options. The option prices are very cheap. Corn puts are very cheap. Corn calls are just implied volatility is nothing, meaning the options are about as cheap as they've been in a very long time. Get creative enough, you can figure something out. Now, with the stuff going in storage, do you want to own Courage calls? Courage calls absolutely didn't work this spring going into summer. Anybody bought them for the summer? It didn't work. It never got up to the price for you to market it, to give you the Courage.
I hadn't looked at this, though. So, Courage, right? You're talking?
Yeah.
I hadn't looked at corn until you just brought it up.
They're almost free.
4.5 cents for the $5 corn call in March.
Yeah.
March. You have you have 207 days. Am I looking at March? I'm looking at March 26, $5.
Yeah.
For 4.5 cents.
Everything's very, very cheap this year.
200 days.
What I want to do is come up with a plan where we're getting some of this stuff bought eventually.
I'm not saying to buy that. I was just shocked by the price.
Oh yeah, they're all very, very low. Puts are low. Puts aren't even working when you have directionally the price right.
Well, that's because like you said, implied volatility is just in the dumps, and so even if the price moves and the volatility goes down, you don't make any money.
Yeah. So if you have grains to move and you don't have storage for it, the calls are very easy to own. Now, the problem we've been having is that there's no margin there. You're selling at a loss, and then you're throwing in some more money on top of a loss.
Right.
But if you do want to re-own it, that's the cost of re-ownership. You definitely can buy calls. There's never been an easier year or cheaper.
Not interest on options.
Yeah, there's also not interest on options if you're going to sell physically.
Fees.
Yeah, and you can avoid all that interest, and then you can just own calls. That might be something we're looking at in the days ahead. But it is very cheap, so it's always a good deal. You don't want to be a seller, you want to be a buyer. But if it's not going to move, you also don't want to be a buyer. So you see hinted at on Twitter a little bit. Sell the strangle, although it's not official recommendation. Of course, that one was saying.
Yeah, and that's when the people come out and tag the NFA, like at NFA.
Well, not a strangle, straddle. Yeah, and I want to buy. I'm going to end up probably wanting to. Well, it's probably going to be better to buy it than sell it right now. But now it's so low that I don't want the put side.
Right.
And I don't really want the call side because, the market is what it is. So it's, round and round we go. There's not a lot of good opportunities. But back to what we had said before in previous episodes, this is the time to plan. Like, hey, when it looks like the bottom, or seasonally it looks like we're there, or hey, it's done going down, or you don't think the options are going to cheapen up, we'll be definitely looking at this for clients.
We're watching the spreads, and that's what you should be too.
Yep.
And spreads is where you're going to, two places. Spreads and basis.
Yeah, which are close cousins.
You need to watch the basis. Don't watch your local basis. Watch national basis. Look at a few areas and watch the spreads. And you're going to be able to see when it is time to do one of those things, whether that is buy calls, whether it's buy a straddle, maybe it is sell a straddle. No, but not a recommendation.
And ultimately, you want to get there to where you're not listening to the news, that you're watching for what he just mentioned, the stuff where the professionals are actually watching, the gray merchandisers, everybody. Like, there's things you can follow. Does it always follow fundamentals? Absolutely not. But again, the corn spreads, without a doubt, last year there was huge warning signs given off well before the top came in that it wasn't the numbers they said the USA said it was. If it was that tight, we'd have been inverted, stayed inverted, got more inverted. March, May was a terrible carry. May, July was a terrible carry. That's never happened with those numbers before. So there was warning signs. It's a big part of what you should be doing. You should be listening to less news. Is there good resources online? No. I mean, you guys will argue that Twitter's an awesome resource, and it can be. I mean, there is stuff there, but there's so much sifting to find the good stuff. But if you're doing really well for yourself and you're making money trading or hedging, why would you share that with anybody? I mean, that's where you really got to look at. Why would anybody? Well, people that are selling stuff will share just enough to get you. Well, he must know something, so I'm going to buy his subscription. But you want to look at real simple stuff, and that's going to tell you, even if you just track what the funds are doing and watching their positioning, that can help out a great deal. You want to focus, because what we're going to find is you're going to find more AI, you're going to find all these written articles, you're going to find more information coming at you faster than you've ever seen, and it's only going to speed up. And I don't think that it's going to be really helpful to people. Most of that's going to be already in the market. It's going to seem like it's new information because we haven't had it before, but the speed at which you can get information out now, especially with AI, you're going to see 1 million newsletters. There's already 1 million. You're going to see 1 million plus 10 because it's going to be so easy to do. But that's not what's going to help you find better spots for your hedging. It's never easy. And reading more is not going to probably help you. What do they call that? Analysis paralysis.
Absolutely.
So it's going to get confusing, and it probably already is. Like, if you looked at enough Twitter right now, you'd be convinced there's no corn out there and it didn't pollinate right. And so why is the market ignoring it? Why is it? And then you'd start getting angry. And then you'd start talking about it below the cost of production. It's being run down. It would feel like the market's trading against you. This happened back in February, and we've talked about it a couple times already. And these guys are on the right side of the trade because there's no reason to let up on it. Now, of course, it'll go too low, as it always does this time of year, and it'll bounce out of there, and we've already seen good demand. But sometimes you just got to realize the market is right, and maybe they are trading the right numbers, and you're wrong. And that's what it feels like this year. Is these guys were right in February, and at one point it'll get too low, and it doesn't need to be at that price, but it sure doesn't feel like it yet.
Yeah. Well, one thing's for sure is whatever the price is that day is the right price.
It is
that day, and that's all you can trade.
Yeah.
So.
And then like we were saying, look for clues. And beans, what I just talked to you, the crush margin. That's actually very useful stuff. That was on Twitter. Everybody's exchanging that information. That's useful information. And then there's 500 right behind it that's just complete garbage, looking for attention, looking to be an egg influencer this next year.
Well, that's the other thing to remember about anything social media. And you and I mainly, really for any grain information or any commodity information, Twitter is really the only place to get anything.
Well, it's a new news feed.
It's the new news feed, absolutely. It's cheaper than your Bloomberg terminal, that's for sure. But
with a lot of people's bad opinion, that's what you get for free.
That's what, when you're getting it for free, like this podcast, you got to sort through what's there, though. And my point where I was going with this is anything on social media, remember there's a large majority of people saying dumb stuff on purpose.
Yes.
To get people angry, to comment, to say things, to grow an audience. They're just putting it out for engagement.
Yes, engagement equals money. The more followers, the more money, and not just in eggs and anything. So the more people you can get stirred up, or you can get, in front of people, and the more views, the more money you're going to make. So there's definite intent with a lot that's set out there. Yeah.
That's why our next episode is going to be ranking the top 10 worst just X feeds for commodities.
It's
just kidding.
Is
we
there
will
even
not do that?
We won't do top 10 or top.
We need to do a top
because I don't
100.
even think there's 10. I think there's like 2.
I said
two
worst.
or 3.
I said the top 10 worst.
There's 100.
There's 100. Yeah, we're gonna have to start.
No, but don't. It gets confusing, and I think it's been this way for 2 years now, where people aren't understanding why the market's doing what it's doing. My point is, you can overdo it, but look for the clues, and then you can start getting some of these, on the right side of stuff, instead of just getting angry and saying it's completely wrong. And right now, everything just points down, seasonally or otherwise. But we're going to get to a time frame pretty soon that it doesn't point to that. But the first clue that beans are close to the bottom is probably the crush margin.
Yep, start watching those spreads. That's the biggest thing I can say from what we talk about, what we do, and we'll try and keep conveying those ideas on these podcasts. And
yes.
We'll try and put them on the beginning, maybe.
Yeah.
But only the good ideas will be at the very end.
And all the bad ideas edited out later on, of course.
Exactly. Yeah. We have never gone back and edited in an episode.
No, we wouldn't do that. But you can go look at our library. Actually, if you're a new listener, go back and look at even the headlines we were talking. You don't have to listen to the whole thing, and you'll see that. I
would say it's worth looking back at the same time frame last year to see that lots of times there's nothing new under the sun.
Yeah, what happened this year, the only difference we had this year than any other year is that it fell 2 months early, which is a big difference. But the big one, in my opinion, was the weather. Like you don't have these 2014 type of years that often.
Yep.
Where it's just good and there isn't 3 days they worry about the crop in a row. That's unusual. That's what you call bad luck for hedging, because there's a fine line between flinching too early and then flinching too late. The last few years, clearly you should have been making moves. And this year was the one year where you had to see some weather before you could, and it was already too late, which is unfortunate. And there's going to be these years, and this was definitely one of them. You won't find me saying this was an easy hedge year at all. It was one of the more difficult ones. I think you have to go back 3 years ago where it was very hot and dry, yet the USDA had a very high yield still. Nobody can market anything because they had no idea what they were going to even have on the farm,
yep.
And it ended up being a big crop.
That is the problem with high prices, is it usually means some to a lot of producers are having some very bad days.
Yep.
Low prices means you generally, the crop looks really good and you're going to have a nice harvest. Sorry, your prices are horrible, but for prices to be high, it usually means somebody's in trouble, and that's not any better.
Yeah, and where are we going to go here in August? We actually have this weather pattern, so you're going to have guys doubtful that is that yield, but then all of a sudden they're going to see these ears growing, they're going to see the pods filling on their beans, and then panic will set in. So are you going to see guys throw it away at the bottom here, or is it going to go in the bin again? And I didn't even get to it. Next episode is going to it's the whole front of it is going to be talking about grain storage.
Yep.
And maybe we'll get a grain storage guy in here. It won't be that interesting because they build them and they do that. But we'll talk to a guy on the commercial.
Nice pitch for an episode, though. I'm glad that's at the end. We're gonna get a guy in. It won't be that interesting.
More on the commercial side, not in the physical building side of it.
I'm just kidding.
Just to see what the fees are, on the commercial storage versus what you have on farm.
Yeah.
But it's going to be okay. So it's been store it and ignore it, and that just hasn't been working for years.
Yeah.
So we'll go over what has been the new storage strategies that have been working.
Yeah.
And you're not going to like them. It involves a lot of the logistics are a nightmare, meaning it's going to go in and come out very quick, and that goes against what you got the storage for.
I've told you my idea to help farm marriages, haven't I?
No.
I digital displays on every bin with exactly how many dollars are in that bin, changing with the live commodity price
per day or per tick. Make sure everybody goes insane on the farm. Yeah, that'll be a good idea.
Yeah, just the LED screen in dollars.
Could have bought
it just goes up and down.
Could have bought a new truck if you'd have just sold that today instead of tomorrow, like you're going to do. Yeah, that kind of stuff. It'll be the whole episode, or the front half of it. We'll talk a lot about storage and how to use it, or how I think you should use it. But back to Ryan, we'll kind of end on this. The think about if you don't want to sort of pay that interest, start pricing calls. Give us a call and we'll go over numbers with you.
Yeah.
Because you can re-own it for a long time, and it's very reasonable this year. Is it perfect?
Doesn't mean it's a good idea.
No, and there's not much meat on the bone here to get. So even if we rallied and it goes up 30 cents, you're not going to make much on your options.
Yeah.
So it's not like this end all be all, but it's at least there's going to be guys that don't have physically the room that are going to have to sell it at the market, and that kind of stuff. But all in all, I'm looking forward to a Monday that's better than this. I've been bearish, but it's still no fun at all. I mean, even when guys are sort of on the right side of the market, it's like it wears on you after a while just seeing nothing but negative grains. I mean, it's nice to mix it up and have a little bit of both sides once in a while, but not lately.
I mean, being the hedge heads, I like markets that you can hedge.
Yeah.
And I mean, really, on the main markets we trade, both grains and cattle, it hasn't been possible for months now.
Last year for cattle, it was the board was so bad, and it was the futures so far under the board, and it was in the 170s, and we have almost the same amount of meat around as we did year over year, and the demands changed that market. So it went from a very bad hedging market to a very good hedging market, but then it went very bad because it went way higher.
Yep.
And that's kind of where we are there. But cattle is a market without a doubt that you should be looking at hedges at. But that is something you definitely want to do very carefully. Very dangerous market, but you also want to be able to get this price next year.
Absolutely. Love it. Well, John, last week you did not leave your number, or 2 weeks ago because we took a week off. So make sure you leave your number today.
It's this summer. I mean, everybody gets busy and they're all over the place.
No one wants to talk to you anyway. You're out fishing.
Yeah, fishing. I would love for the markets to be exciting to talk about, and they're just not. But anyways, if you have questions on anything we're talking about today, 218-731-1578.
Thanks, John.
Yep. Okay, so now we're having fun. Let's get all this out of there.